Welcome to this week's Friday 5 on CBT News, where we recap the last week's action in automotive technology deals. My name's Steve Greenfield, and I'm the CEO and founder of Automotive Ventures. U.S. stocks wrapped up a banner month, with the S&P 500 posting its best August in more than 30 years. The S&P 500 stock index capped a remarkable 5-month winning streak as improving labor data, central bank maneuvers, and big tech's continuing dominance helped fuel a succession of milestones on Wall Street, even as the wait continues for a coronavirus vaccine and full economic recovery. The month's advances propelled the S&P 500 to record levels, ending the shortest bear market in history after ending the longest bull market on record. The NASDAQ also set an all-time closing high, and the blue chip Dow is now in positive territory year to date. High stock market valuations and optimistic investor sentiment is leading to our second topic, the SPAC. A SPAC is a special purpose acquisition company, sometimes called a blank check company, a shell company that has no operations but plans to go public with the intention of acquiring or merging with a company utilizing the proceeds of the SPAC's initial public offering. While garnering a lot of press recently, SPACs have been around for decades. SPACs make it relatively easy and more straightforward for a company looking to be public, as opposed to going through a more typical long IPO process. So what does a SPAC have to do with electric vehicles? SPACs and electric vehicle startups seem to be a match made in dealmaker heaven. Canoo is set to merge with Hennessy Capital Acquisition Corp., following in the footsteps of electric vehicle specialists Nikola, Fisker, and Lordstown Motors, which have also recently inked deals with special purpose acquisition companies. Electric vehicles are getting momentum due to the strong performance in Tesla's stock price year to date, which has run up from $86 per share to a recent high of almost $500 per share. In addition to electric vehicle manufacturers, many other companies are taking the opportunity to go public via SPAC. Online car seller Shift Technologies is set to go public through an acquisition by SPAC Insurance Acquisition Corp. Shift had originally announced back in June that they would be public sometime in Q3 2020. So time is running out to hit that window. Shift recently had their analyst day for Wall Street analysts, which is a signal that they should be public soon. Our final deal for the week is Car Global's acquisition of online wholesale dealer auction Backlot Cars for $425 million. Car Global is the parent of ADESA, the second largest physical auction company behind Cox Automotive's Mannheim. The acquisition of Backlot Cars is an attempt by Car, who owns the number 2 player TradeRev, to keep up with number 1 online player ACV Auctions. Word on the street is that ACV may be looking to IPO sometime later this year. Maybe they need a SPAC. $425 million is a lot of money, but Backlot Cars has been growing quickly, and the consolidation by TradeRev just makes a lot of sense. During an earnings call, Car Global Management recognized that Backlot Cars sales volume is similar to TradeRev's 158,000 sales last year. That would put that combined entity at over 300,000 units sold per year. In comparison, ACV recently noted that they were selling about 40,000 units per month, which would put them on a pace to annualize sales of almost 500,000. So that's your weekly Friday 5, a quick wrap up of the big deals in the automotive technology space over the past week. Tune in next week for our next recap. It's an exciting time for automotive technology companies, and we should see a lot of M&A activity over the remainder of the year. Feel free to share any comments you have at my email here on the screen, and thanks for tuning in. We'll see you back here next week for the Friday 5 on CBT News.